Best has completed its annual review-preview analysis of the U.S. life annuity insurance sector. Joining us today to discuss some of the findings are Managing Director Ken Frino and Director Tom Rosendale. AM Best recently revised its market segment outlook from negative to stable, predominantly due to improved risk-adjusted capital and increased liquidity. What do improvements in these areas allow companies to do that perhaps they couldn't do before? Tom, would you want to take that?
Sure. And I guess when you talk about having more capital rather than less, it's like any of us, we run into extra money. The possibilities are unlimited. But you know, I would say that most companies coming into this year were in either the strongest or very strong category in terms of our assessment of their risk-adjusted capitalization. So they're already in a pretty good position. What we're seeing is companies are banking even more capital, and so it gives them a lot of opportunities. But you know, probably the most important would be that they've got a buffer for any type of market stress that could be coming in the future. So they're better positioned from that perspective. But then from the standpoint of deployment of capital, we see a lot of companies investing, obviously, in technology and insuretech and other areas that would affect their business model going forward. So, you know, it kind of allows them that, you know, that luxury of being able to invest a little bit more without being too concerned about, you know, deteriorating their capital position. From a liquidity perspective, I think I just point out that external liquidity is really where we've seen the improvement. You know, even internal liquidity has been relatively stable, but there have been some kind of you know, yield for liquidity trades going on within investment portfolios. But the big advancement really has been the tremendous membership in the FHLBs and other sources of external liquidity that really you know, give them that flexibility to you know, to use their liquidity backstop rather than sell a security in an unfavorable environment.
Yeah, and just to add, the industry as a whole, if we take a look at operating performance in 2018, it goes along with the buffer and the buildup of capital to allow companies to withstand volatility. And we saw some volatility towards the end of 2018. But certainly, as Tom was mentioning, when we look at risk-based capital and liquidity, companies have certainly built up a strong or stronger position in both of those areas.
So Ken, M&A is not only picked up, it's involved some non-traditional players. What do the characteristics of the deal activity tell you about where the market is headed?
Yeah, it's interesting when you look at the deals that occurred in 18 and maybe even going back a couple of months into 17 when some of the deals were announced and closed in 18. You're seeing companies and the transactions move to all lines of business now, and maybe splitting it up between mergers where, you know, companies go out and buy another company. And we saw some there. We saw Kansas City Life and go out and purchase Grange, and Western and Southern Gerber Life. And both of those transactions focused on product and distribution to bring in-house areas that the company thought they need to strengthen, so they went out and purchased those companies. And then the second piece are these block transactions that we see. And they're significant in terms of the amount of reserves as well as the financial term back and forth between the companies. And what we see there, we see, and going back to my first comment about all lines of business, it's not just mortality. The deals included variable annuities, fixed annuities, even a long-term care deal. So it's opening up, the market has opened up quite a bit for transactions and companies looking at lines of business that you typically wouldn't see in transactions. And our thinking is that as we go into 19, we'll see more of these block transactions. I think the focus will be on the block transactions and companies looking to offload legacy books of business where it can free up capital for them and invest in their core businesses.
So reaching the middle market has been an ongoing strategy for insurers for some time. Do you think ultimately that the market can be captured, and how do demographics play in favor of those goals?
Yeah, I'll start with that. There's a lot there. It's something that year after year we see companies saying and telling us that they got to penetrate that market better. They need to do a better job of providing products and services to that marketplace. And there's many dynamics that kind of play into that particular segment of the market. One being the process of from the application to underwriting and the ease of doing business. There's also a component of direct-to-consumer, trying to figure that piece out. And also cost, just trying to lower the cost to make it affordable and something that, as a consumer, you want and can afford.
Yeah. I think I'd also add that, in addition to what Ken mentioned, this is it's very product specific too. So the challenge is particularly acute in the life insurance space, because that's a product that's, we've always said it's more sold than bought, and the dynamics of the traditional career agent and independent agent distribution channels don't really have the cost structure that supports efficient distribution of that product into the middle market. So the conundrum is finding a way that's cost effective to get life insurance to the middle market, but also incent those individuals in the middle market to want to buy without the the impetus coming from a face-to-face visit from a career agent or an independent agent. So that's the difficult aspect of it, and so it is very product specific. Maybe it's a little easier in the annuity space, med sup space, things like that. But life insurance is a challenge, and I think that's something that we don't yet know the answer to.
So are life insurers embracing insuretech, or is there still some friction there?
Well, I think it's very much a company-specific answer. I mean, as you know, we rate companies across the whole spectrum, right? You've got the large public companies with tens of billions of capital, some of the big mutuals with tens of billions of capital, and then you've got the the monolines with 5 or 10 million of statutory surplus and everything in between. So I think the reality is it's a function of resources. So I don't think the industry has their head in the sand as it relates to insuretech in any way, but it is a matter of who's got the resources. So the companies that have those resources available to them are the ones that are more active in the insuretech space. Some acquiring, some partnering, some even creating research environments in order to find alternative business models or enhance their existing business models. So I think they are embracing them where they can. For those companies that don't have the resources, I think they're hoping, much like we saw with the development of universal life back in the 80s, where no one had the admin system to handle it. Companies sat on the sidelines until some of the bigger players who got into the business early worked with third parties to develop admin systems that became available off the shelf, and then other players moved in, bought those systems off the shelf, and were able to get in a more cost-effective manner. So I think some of these smaller companies are hoping that becomes available as an off-the-shelf option for them later on, but they're going to be followers and not leaders.
And Ken, where is regulation headed in the next year or so, and what should insurers be doing about what's coming down the road?
Yeah, they need to prepare, and we've definitely talked to companies where they're at in terms of different regulations and proposals that are out there. So just to name a few, there are certain regulations that are a little further along than maybe some others, but starting with variable annuity hedging. There's also a suitability. It goes by New York State Regulation 187. There's also principles-based reserving, and then the changes to the NAIC risk-based capital model, where they're looking at changing the risk charges in the C1 section of the model, and that one will probably get more visibility because it affects all companies, and so what the change there is to the risk factor. So companies really need to prepare and take a look at their portfolio to see where they're at today and where they will be once those charges are implemented and in force.
Yeah, and I would note that as Ken mentioned, Reg 187, which is in the state of New York, we saw the vacating of the Department of Labor fiduciary rule The SEC has its own that's being proposed. Reg 187 goes a little bit further and is more broad-based in terms of the products that it applies to. So that could be of particular concern to a lot of insurers because they didn't really prepare for that level of, oversight, I guess. So Reg 187, if it gains legs, gains traction with other states, could be something that is, going to require companies put a lot of resources toward and could affect their ability to sell effectively into the market, at least in the short term. So there is some concern about that, and also with regard to NAIC RBC, which Ken referenced, that is something that's going to affect all companies. Interestingly, as we deal with companies with our own risk-based capital model, we don't have those issues because it's it's already been tax affected, right? Mm-hmm. So we're not having C1 changes related to the change in the tax code. So so we've got to kind of reconcile changes in the RBC formula relative to no changes in our risk-based capital model. But to Ken's point, it does affect everyone.
Tom and Ken, thank you for speaking with us today.
You're welcome.
Thank you.
To view a full copy of the report, visit aminvest.com. For AM Best TV, I'm Meg Green.